You've paid every rupee of tax you owe, but you still panic whenever you see an email from the income tax department. You know that feeling, right? Look, if you're nodding your head right now, trust me, you are absolutely not alone. And honestly, who can blame you? It is a heavy, sinking feeling. But what if I told you that being a high taxpayer might actually make you an easier target for automated scrutiny? Welcome to today's Explainer. I'm your host, Anita, and we are unpacking a literal masterclass on tax compliance today, based on some incredible insights from Mr. Ramesh, a former income tax officer with decades of frontline experience. We're going to completely demystify how the tax department actually selects returns for scrutiny. We'll explore exactly why honest taxpayers are so scared, how these automated data systems really work behind the scenes, and what you absolutely must know about the big transition to the new Income Tax Act 2025. By the end of this explainer, you'll have the exact knowledge you need to shift from feeling like a sitting duck to feeling completely secure. So let's get into it.
Section 1. Why honest taxpayers panic.
Okay, let's dive into this. Why is it that professionals and business owners, people who pay massive taxes, sometimes upwards of 50 lakh or even a crore rupees, why do they still get absolutely terrified when they see a communication from the tax department pop into their inbox? You've paid your dues, so why the panic? Well, what's really fascinating here is that this fear is largely psychological. According to Mr. Ramesh, most taxpayers instantly associate every single email with deep trouble. But actually, not every communication is a dreaded scrutiny notice. Sometimes it's just a routine intimation telling you they've processed your return, or maybe it's a refund adjustment, or just a quick request to fix a defective return. Receiving a communication absolutely does not automatically mean the department thinks you've concealed income.
Section 2. The high tax myth.
And that brings us to one of the most persistent and honestly most dangerous misconceptions in the financial world. Does paying a massive amount of tax guarantee your safety from the department's radar? Like, does it buy you immunity? Let's just break this myth wide open. Take a look at taxpayer A. They paid a whopping 40 lakh rupees in income tax. Huge amount, right? But they ignored some interest income, claimed incorrect TDS, and completely ignored mismatches in their annual information statement. Now look at taxpayer B. They paid only 60,000 rupees in tax, a fraction of the amount. However, they reported every single source of income perfectly, fully reconciled their data with their AIS and 26AS, and kept all their supporting documents. Mr. Ramesh shatters the myth right here by confirming that taxpayer A is actually at a much, much higher risk for scrutiny. The system doesn't just look at a big number and say, oh, they paid a lot, let's leave them alone. No way. It specifically looks for inconsistencies.
Section 3. How data triggers scrutiny.
So, if it isn't the sheer amount of tax you pay that triggers an alert, what exactly is it? How does the tax department even know what they're looking for? Well, the answer lies in the sheer power of modern data analytics. The tax administration today is incredibly data-driven. The department isn't just looking at the form you manually fill out anymore. They are constantly receiving massive streams of third-party reporting. Think about it. Your employers are reporting your salary. Banks are reporting your transactions and interest. Mutual funds and stockbrokers, they're reporting your investments. Property registrars are flagging your real estate deals, and TDS deductors are submitting their own records. All of these different streams automatically feed right into one unified taxpayer profile. The system already has a remarkably clear picture of your financial life before you even log into file.
So the absolutely crucial point here is data reconciliation. This is basically the automated process where the department's technology takes your filed income tax return and cross-checks it against your annual information statement, your AIS, and your Form 26AS. But here is where you can take a deep breath. The technology simply flags the mismatches. That's it. It doesn't automatically conclude you've committed tax evasion. As Mr. Ramesh reassures us, if a mismatch is flagged by the AI, human officers still step in. They actually apply the law to determine if a real violation occurred. The technology just assists the process, but the law and human oversight still govern the whole shebang. You always have the right to explain your position.
Hey, real quick, if you're finding these insider insights helpful and you want to make sure you stay completely off the department's radar, make sure to hit that like button and subscribe right now. You definitely won't want to miss our upcoming compliance checklists, which can honestly save you a massive headache down the line. Okay, let's keep going.
Section 4. The 2025 Act Transition.
Let's shift gears to one of the biggest changes happening right now. There is so much confusion among professionals and everyday taxpayers regarding the recent transition to the new Income Tax Act 2025. So let's clear the air. The old Income Tax Act of 1961 is officially being replaced by the Income Tax Act of 2025. But please, don't panic. This is primarily a simplification exercise. It's not some sweeping policy shift meant to hike up your taxes. Just look at the length. We're going from 819 highly complex sections down to a much more manageable 536 sections. The drafting style is shifting away from all those confusing provisos into simplified modern language. And perhaps the biggest win? That incredibly confusing dual concept of having an assessment year and a previous year is being completely replaced by one unified tax year. It's a real game changer designed to reduce compliance friction, not increase it.
Now, understanding the timeline of this transition is absolutely vital. The 1961 Act era officially comes to an end in March 2026. Then, from April 2026, the new 2025 Act becomes totally operative for the new tax year framework. However, and this is exactly where people get tripped up, when you go to file your returns in July 2026 for the period that just ended, you will still be filing under the rules and forms of the old assessment year 2626. This means the two acts will basically coexist for a transitional period. The old act continues to govern earlier tax years until those specific proceedings are completely finished.
So how do you actually survive this transition without pulling your hair out? It's simple, really. As Mr. Ramesh points out, the administrative frameworks you already know, they aren't going anywhere. Your existing PAN and TAN remain perfectly valid. The faceless assessment and appeals schemes will continue without a hitch. If you have old approvals like registrations for a charitable trust, for example, they automatically carry over as long as they don't conflict with the new act. And any pending proceedings or notices that were issued under the 1961 Act will just finish up under those old rules. You absolutely do not have to start from scratch.
Section 5. Staying out of scrutiny.
Okay, pulling all of this together now, what is the ultimate golden rule here? How do honest taxpayers safely navigate this highly automated, data-driven landscape through both the old and new acts? Listen closely. Your strongest protection is not fear. It is accurate, complete, and well-documented compliance. Remember, the system doesn't target you just because you have wealth, and it certainly doesn't ignore you just because you paid a massive tax bill. It targets data inconsistencies, period. The absolute best defense you have is thorough reconciliation. Before you even hit submit on that file, you must ask yourself, does my return perfectly match the annual information statement? Does it match Form 26AS? Because if the data aligns, you dramatically reduce your risk of avoidable scrutiny.
A massive thank you to former Income Tax Officer Mr. Ramesh for helping us decode this complex system today. But hey, we are literally just getting started. Make sure you click the next explainer on your screen to watch part 2 of this series, The Scrutiny Trap Explained with real-life case studies, where we'll look at the exact real-world mistakes high earners are making right now. Until then, I'll leave you with this final thought. In an age of AI and automated data matching, will your next tax return be a glaring target for scrutiny or an impenetrable fortress of data? The choice is entirely in your compliance. See you in part 2.